so let's start, Prashanth, and as what I usually do, Prashant, just repeating for your benefit. We would like we would obviously keep this a very fun and interactive session. And the initial 25-30 minutes, I think you and I will talk one on one, where I have a few questions to ask you, and depending on how our conversation goes, follow up questions. So we'll keep that for 25-30 minutes, and then we'll open it up for the audience round. And in case people have any questions to ask you, then we'll take them one by one. So I expect the entire space to last for about an hour, or maybe hour or 15 minutes thereabouts. So hope that's okay with you.
Yeah, I'm fine. I'm fine with it, kind of thing.
Great, fantastic. So, Prashant, let me start by asking you. I mean, I obviously have got to know you a fair bit since we have been now speaking and interacting with each other for the last few months. But maybe for the benefit of everyone. So, what's been your personal background? Your where are you originally from? And if you could help us understand, how where did you spend your childhood, what's your education, and little bit of your personal background before we move to market related discussion.
Sure. I mean, basically, I'm from Bangalore, born and brought up here itself. So, I mean, spent much of my life, other than maybe a year and a half in Bombay, I spent more or less all my life here in Bangalore. So I am not exactly a finance professional in terms of my education kind of thing. I mean, I had a clumsy education. But the reason I wanted to get into markets was because basically I saw money kind of thing. I mean, greed is good kind of in a way. So I saw someone, a very good neighbor of mine, I still know kind of thing, who made a lot of money in the 1992 Mehta bull market. So that was what actually attracted to my market. But actually I came into market via, as a canvassing for IPOs and fixed deposits kind of thing. I mean, that was my way into the market kind of thing. And then I became a stockbroker. I mean, and more recently have been more of a, advisor and other things kind of. But more of a, not a smooth, I don't have a MBA or, I'm not in that. I started around the industry in around 96 or 97 kind of thing. So at that point of time, there's no internet kind of thing. And the exposure that for me in Bangalore was very low. Very limited in that sense. Even Bangalore Stock Exchange, where we had around 300 members, I don't think majority of them were not really professionals in the terms of, being educated. Say what you find now kind of thing, wherein people are do have a MBA or a CFA kind of thing, when much more prepared to enter the market when they start off kind of thing. Most of us who started off, just because of, maybe because it was a job that one got, or basically, it was something that we chose, not because we felt that this is a great place to be in, but it was a nice place to be in kind of thing. And even in those times, money was the most biggest attraction kind of thing, because you take the Maharashtra Mehta bull market, or later on the .com kind of thing. We have seen people make pretty large sums of money kind of thing without really, not enough of base kind of thing. So that actually is attraction kind of thing. Even today when you look at all the people getting attracted, it's because of the multi-year bull market. It's like every dip I just buy and let it go. I'll always make money kind of thing. So that, the attraction, it comes because of the money part, other than, I think, psychological part in a way.
Got it. Right. So maybe I missed that, but you are born and brought up in Bangalore, or you?
Yeah, okay. I'm here itself.
Okay. Got it. Got it. So you started your career, you said, in your stock market career in 96, you said, right?
Yeah, 96, 97. As a primary, I was initially a primary IPO, broker for IPOs kind of thing. At that point of time, you could sell IPOs, we could get commission for the IPOs kind of thing. We had a brokership. So I was a sub-broker with company called Shivan & Company, which was later, you would know it as this guy, Siddharth, and the coffee day guy.
Oh,
His original company was a Bangalore Stock Exchange broking company called Shivan and Company.
okay,
I was a sub-broker there for the primary markets.
okay.
And then I entered the secondary markets more of as an investor rather than as a, what do you say, uh, broker kind of thing. But I quickly realized that being a broker was a very, at that point of time, broking was a very good space to be in kind of thing. It was restricted. Even though NSE had come and NSE was large, we still had around 32 stock exchanges kind of thing across India, regional stock exchanges, which had decent volumes.
Yes.
Till the dot-com burst, we really
Hmm.
were doing pretty good. Calcutta was a large stock exchange. Delhi had a very large stock exchange. So
Hmm.
we had some very good businesses kind of thing, and the entry barrier was very low. The
Hmm.
biggest advantage of becoming a broker at those times, even today, the entry barrier for becoming a stock broker is low. But the point is now the competition is so tough, you don't make money out of broking kind of thing. But at those
Yes.
times, we were
Hmm.
charming. You could get away charging 2.5%, and then over and above kind of thing, you could actually pad up kind of thing. A lot of things used to happen in those times. Because it
Exactly.
was not electronic. And, even though we started getting into electronic most probably in 97 kind of thing. After NSE
Yeah.
came, everyone was
Hmm.
forced. Basically, all the exchanges, we were all outright systems before that. But
Yes.
once
Yes.
NSE came, we were forced to shift to the electronic systems kind of thing.
Hmm.
So even then, it was actually, broking industry was a very interesting niche industry which attracted a lot of people kind of thing.
Hmm. 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 Right. I remember, in fact, of course, I myself was not even probably working at that time. I was probably a student, but from my father, I do know that, you know, the broking industry was very unorganized, and there used to be a lot of, the way the brokers used to really sort of milk their clients, and there used to be things like, if someone has placed an order, and if the broker gets the shares at an even better value, he used to keep those shares himself, and or something, something of that sort. So uh,
Those all days are way, way different kind of thing. We had weekly settlement. We did, it was not a daily settlement kind of thing. So you could
uh,
actually open positions open for a week. And then we had concept called Badla, wherein you can just carry forward the positions without paying anything kind of thing. Only the mark
uh,
to market is.
uh,
Because, in that sense, actually, broking has much more evolved kind of thing, much more better for the ordinary investor. Because those times we never knew, as you rightly said.
mm,
Brokers used to pad up kind of thing. You always bought at the highs and sold at the lows of the day, kind of approximately, more or
uh,
less.
uh, uh,
So, unless the brokers really, you can't really be a buyer at the high and low, seller at the low all the time. So, a
yes.
lot of padding up went on in addition to whatever high, what do you say, the brokerage charges of those days. Actually,
Yes.
look back into it, 5 paisa, in 2099, 2000.com, 5 paisa got launched, India Infoline. That was the
Hmm.
first real, what do you say, change from charging clients 0.1 for 0.5, whatever you felt you could charge, to a
uh,
much more lower percentage kind of thing. 0.05 was, became a starter for 5 paisa, which was what,
hmm.
5 paisa.com was basically said 5 paisa per 100 bucks kind of thing, 0.05%.
Yes.
So
Yes.
in that sense, from there to today, pretty much you can invest without actually paying a rupee in brokerage kind of thing, which has been a
Yes.
phenomenal thing.
Yes, yes. In fact, many of the discount brokers, like even Zerodha, they don't charge anything. They don't charge any brokerage, right, for
Yeah, yeah.
deliveries.
For deliveries, they don't charge. Zerodha doesn't charge. They have been not been charging. My own for last 4 years, I haven't paid a single cent of rupee to Zerodha.
Hmm.
And yet phenomenal service, phenomenal. The quality of. Look. Even if you go by the software, everything is good, and you
Yes.
pay nothing kind of thing. If I go back in my, I still have the contract notes of my previous when I used to trade kind of thing. The amount of money
Hmm.
we used to spend just for the the amount of money we used to give to broker, that was, that's a different age itself. Yeah. I don't think we'll ever go back to the age kind of
I,
thing.
I know. Yeah, I agree. It was like, those initial days of cell phones, where you used to pay 16
Yeah,
rupees for.
very
Yeah,
true.
yeah. I agree. Absolutely. So fine. So you started your career as a, a sub broker, and then how did your journey progress from there onwards? What was your next role that you played in the market?
So basically, I mean, very early I could realize that broking was where the money is kind of thing. I mean, money was at that point of time, I think in 97, 98. I mean, markets, I mean, if you go back to the 90s, markets were not really as strong as we are talking today kind of thing. I mean, those were the days of, what do you say, the coalition governments kind of thing. And I mean, I came in during the Deve Gowda, IK Gujarat period. Those are times we could actually sleep off kind of thing and market would not do nothing for the whole day kind of. I mean, 5 points in Nifty was a big deal. So those times actually I realized that what do you say, stock broking was the best opportunity kind of thing. But again, even at those level times, it was what, around 8 lakhs or something for becoming a Bangalore Stock Exchange member. Your Bombay was around trading around, crore and a half kind of thing. So Bombay was out of reach, but 8 lakh, even 8 lakhs was out of reach kind of thing. Then I became an investor kind of thing. I mean, .com bubble, I got lucky kind of thing. I got lucky in terms of, being in Bangalore. We had around 50 companies on the .com, listed on the stock exchange. Literally every Tom, Dick and Harry in terms of the IT market. I mean, a lot of names no one will even recognize today kind of thing. There's companies called DMM Software, Computer Shop. I mean, stocks that went up sharply. I mean, ICS Software, Kaveri Teddy. I mean, I can remember a lot of names of those times. And we got lucky. I mean, at least I got lucky in a way. Got in at a. I mean, those times. I mean, when we speak about 20-year returns of how HDFC Bank. So those times, HDFC Bank, no one used to bother because it had no real credible. What do you say? I mean, today we know HDFC Bank grow. Best bank in private sector and etc. etc. But those times it was not really. I mean, anyone could purchase any amount of quantities kind of thing.
Yeah.
So that, I got lucky in the .com bubble and got lucky twice in the sense that I did not lose all my money when the bust happened. So that actually was helpful to me in terms of, what do you see, using that when basically after the .com bust, we had 2 years of really nothing. Bear market with real nothing to be done. And stocks just on a sliding part kind of thing, if you want to put it that way. We have not seen that since that time kind of. So I took my membership around 2003, and since then, approximately till 2017, I was a stock broker. I thought it was 18 kind of thing. I gave up my membership only after recently SEBI changed over from saying that you can't be a sub broker and you have to be authorized participant only. By that time, I had wanted to give up. So when the changeover happened, I gave up kind of thing. But more or less, I've been in that stock broking field for now 20 plus years kind of.
Okay. Oh, wow. And then I think you at some point in time then you joined you were also associated with Mr. CK Narayan.
Yeah, 2012-13, I was associated with him. I used to develop. I started my journey. When I became investor, initial investor was a value investor kind of thing in terms of trying to read about companies and buying whatever we knew, Peter Lynch model. Even though I did not know Peter Lynch at that time, my first buy, for example, was Tata Steel because I had heard that name kind of thing. Second buy, I think, Reliance. All the known names kind of thing. And then in 98, 99, when the IT bubble started taking off, I started hearing about a concept called technical analysis. So I became more interested in that because there I could see that, it was more of number based, which was more attractive to me because one of the things that we don't do these days much, at least, I see a lot of fund managers do, but not in the retail spaces, go visit the company, visit management kind of thing. I used to do that for a few IT companies. At that point of time in my broking, I was one of the guys who knew something about computers, even though I was no one in the computer industry. There's one eye man in the land of the blind kind of thing. So I was taken to say, something, come with me, come with us, want to talk. There it was all empty, what do you say? Empty cubicles, empty shelves, but the stock was rapidly reclining kind of thing. At that point, I realized that, it was not really a realization, but I felt that I can't gauge a company basically by reading whatever I thought I will read kind of thing. So, in technical, someone introduced me to technical analysis. That changed me. So, CK Narayan, I was actually with him we were developing trading systems, we were developing models to trade proprietary money and other people's money kind of thing at that point of time, 2012-13.
Right. Right. And okay, got it. So at that time you were in Bombay.
Yeah, that was in Bombay, Sion.
Okay. Okay. Right. Right. So and then after that, at what point in time, so you came back to Bangalore, and what was the trigger for the move back to Bangalore?
Basically, I mean, CK, we were a funded company kind of thing. The funder decided to change his. I mean, he is a big guy, big shot even today kind of thing. So
Hmm.
he decided that this was not something that he wanted to be interested in, and
Hmm.
CK decided to scale down a bit. So I
Hmm.
decided to move back to Bangalore,
Hmm.
and I mean, by the time I realized that, I mean, CK, I mean that. Even though it was 1.5 year, I mean, in terms of, I met a friend called Samir. I think
Hmm.
he's here. So it was a very good, I mean, he was, I mean, thanks to him, I was able to, what do you say, smoothen out a lot of things that I had was missing out, even though I was developing models and systems in terms of risk
Hmm.
management. I mean, I
Hmm.
could actually, what do you say, I mean, smoothen out a lot of things. So I felt that maybe back to Bangalore and now get back to trading using systematic strategies and everything. So came back
Hmm.
to Bangalore. But the system, I mean, again, I was recently, I mean, someone asked me, why did you stop? I mean, why after, I mean, I completed my CMT date. I mean, 2014, I did my CMT. So
Hmm.
after
Hmm.
even post that, I did not actually, I mean, 2017, I stopped trading altogether kind of thing. So one of
Okay.
the reasons was that I realized that trading is all nice in the, I mean, what do you say, in all theoretical purposes kind of thing, but requires a lot of gumption and lot of capital. Honestly, capital is a key. I mean, unless
Yeah.
you are talking about a cloud of capital, it doesn't even make sense to be a full-time trader kind of thing.
Hmm. Hmm.
So at that point of time, I mean, I knew Deepak Shnoy from quite some time. So he offered
Hmm.
me an opportunity. So I jumped
Hmm.
at it, and I was there for another 3 years at a PMS. I mean,
Hmm.
looking after the research and other things.
Okay. Okay. Hmm. Hmm. And then eventually, where you are currently, you have started your own firm now.
So this was actually not really a firm. I mean, I started this in
Hmm.
2015 kind of thing. I mean, started this as a blog where I mean, I've been writing in the public arena from say around 2003. I used to write in Money
Okay.
Control. Then I used to host one of India's largest Yahoo groups kind of thing on technicalness called
Oh.
Technica Investor. So we had around
Okay.
5,000 people, which is where I came in touch with Dr. CK, came in touch with Deepak Shinoy, a lot of people. I mean, even today I can spot a lot of people I know from those days kind of thing.
Hmm.
So I used to write there kind of thing. So this started off a way where I could actually continue my writing, which had
Hmm.
stopped because Yahoo Groups had moved. I mean, Yahoo Groups, after Marissa Mayer came in, she decided that this was not a focus area. So
Hmm.
they started cutting out the group's functionality. And I decided,
Hmm.
I mean, either where do I write kind of thing. So I started
Hmm.
this blog. In a way, this was a more of a blog. Only
Hmm.
last year, I mean, 2020, we started off as a advisor. I mean,
Hmm.
I mean, became a research journalist and took a civil registration kind of thing. But till then,
Hmm.
it's more of a blog than actually something that I mean, business in itself.
Got it. Hmm. Got it. Hmm. Right. Right. So tell me one thing now as part of your current setup, portfolio yoga. So what all kinds of offerings are you giving to your sort of clients or customers?
I mean, I am a strong believer in factor models kind of thing, but again, I am more in momentum guy. I mean, I am more
Hmm.
in again technical analysis. If you look at technical analysis,
Hmm.
relative strength, which a lot. I mean, momentum is. I mean, even though it became fashionable only recently, we in technical analysis have been using momentum for quite some time. Even though we
Hmm.
did not call, I mean, we did not rank the stocks maybe in the way that we rank today, kind of thing, but the thought process was similar kind of thing. The foundation was first principles. If you want to go back, it's similar.
Hmm.
So
Hmm.
today we offer a momentum, quality, and value portfolio kind of. I mean, in a way, the idea is
Hmm.
to provide for whoever. I am a firm believer that momentum is the. I mean, look, end of the day, we all have our biases kind of thing. We all have, I mean, the conviction comes from our own biases, our own beliefs. So for me, it has been a strong belief that momentum is good enough for me kind of thing. So my 100% my equity or exposure is momentum only. But that
Hmm.
doesn't mean that everyone has my own thought process kind of thing. So I mean, expanded a team kind of thing. And so we are putting up, we have a value and a quality. where we feel that we can provide same, thought process is the being similar in terms of basically the idea is, can we deliver a better job than what the individual investor can do on himself?
Got it. Got it. So tell me one thing, Prashant, that sort of leads me to ask you a question. Now, in momentum investing or factor investing, okay,
Mm.
basically what happens is that whether it is, people like you, Deepak, and, Alok Jain, and a lot of the other, people in the small case field, right? So all of you have more or less a certain very defined systematic way of defining your small case, and the way you offer, not just small case but generally all those momentum investors, they have a very very mathematical way, very systematic way of filtering out the stocks or rebalancing them, doing it either weekly or monthly or whatever. So everything is very structured. There is no, unlike a value investing concept, there is very little scope for discretion, very little scope for biases or your judgment or discretion, right? So everything is very, so the point I'm making is, do you think because of this very systematic way of doing things, very quant based, very mathematic based thing, momentum investing sort of is able to remove emotions out of the picture, and therefore is able to maybe give a much better return? Is that what any thoughts on that?
Look, bias is the guarantee. Yeah, there. Yeah, we can all talk about systematic and non-zero bias, but bias is there from the time we start building a system. For example, my model is based upon a look back of 252 days. Someone else has a look back of 6 months, for example, or weekly. All these are biases based upon our beliefs, our thought process kind of thing. A system can't be built without biases, in my opinion. Every system has its own bias because the builder is biased. The guy who is creating that system is biased. Guy is creating a system that is based upon what he believes in, not just it's bias free kind of thing. Only advantage of systematic trading, investing, is that emotions are much more tougher when you're dealing with stocks. For example, take a stock that is coming down kind of thing. Now, if you are in love with the stock, if you clearly have done that all the deep analysis, you are supposed to actually keep buying. But the point is, the market is telling you something. Market is saying, boss, something is wrong with the company. You take a company like a Satyam Computers. You go back in time before that retail came in. Satyam was the only stock that was getting really hammered kind of thing of the top. It was of the top three. Satyam, Infosys, and
TCS.
TCS it came in later, but TCS kind of thing. But this was what getting hammered much more, and it had a longer term returns were much more bad than the other companies kind of thing, the bigger companies. So the market knew something. Market may not have known the full thing, extent of the scam, but the market knew. The thought process here is that when you fall in love with a stock, it's very tough to differentiate when you are wrong. When the market, markets may be wrong a lot of times. Market are, that's what why a efficient market hypothesis doesn't hold, because markets are, and in a way, if not for the inefficiency, we wouldn't be making money kind of thing. But at the same time, biases are tough to remove when you are doing it on a non-quantitative basis kind of thing. At least my opinion is non-quantitative becomes very tough. When do you decide, okay, I'm going to cut my law, cut it out and say, maybe I was wrong kind of thing, rather than, so quantity, but in terms of returns, I don't think a momentum will give you any extraordinary returns compared to, it's all cyclic. I think your value will give you similar returns. If you take a 10-year or 15-year horizon, I think your best good value investor, a good momentum investor will give you similar returns. The returns shouldn't very much differ because finally we are all, your return is finally based upon the market itself. It's not, it's not like, we are not Warren Buffett that even if the S&P is down, our strategies will make money kind of thing. Overall, if S&P is down, momentum will be down, value will be down, even the quality will be down. We are just saying to, what do you say, maximize in small areas where we find that, okay, where we can actually add a bit more value kind of thing. But I think return wise, right now, because of the fact that last couple of years, it has been a small cap. Actually, it's been a small cap rally. If you look at 1.5 years of small cap returns, it's similar to momentum returns. It's not really I mean, momentum is not really outperformed the small cap. The only reason we were able to get that return was because all of us were invested in small caps. Along me, Capital Mind, we have our systems are not too. I mean, maybe different. Our stock selection may be different, but finally the end product is. I always have felt it's very similar kind of thing. End product won't change because the final beliefs are similar kind of. So I don't think this is something that should be, chosen because it will deliver a better performance. It should be chosen because it's a differential way of investing kind of thing. That's all it is. I mean, it's a way of if you feel, I have friends who are more pure value based, who wouldn't actually want to invest in a momentum kind of thing. But I mean, that's because they have a very strong beliefs and they have actually their beliefs have held up through time kind of thing. So it's all about my belief, this one, and cycles. I mean, basically, it's about cycles kind of thing.
Got it.
For example, if you go back to 2018 to 20, all of us were underperforming the Nifty. I mean, the momentum, literally everyone underperformed the Nifty 18 to 20 because we were all more in a mid and small cap, which was not moving up, while the large cap was actually moving up. So at that point of time, your quality was doing good. I mean, your Saurabh Mukherjee had a very great returns at those points of time kind of thing. So it's a continuous cycle kind of thing. Right now we are on momentum is in the top of the cycle. At some point we will be at the bottom of the cycle.
Yeah. So you use the word quality. Is quality basically the same as the value in terms of factor investing?
No. I mean, basically, in factor investing, if you take value, at best it's like rank stocks by say price by sales or price by cash flow or whatever kind of methodology, and then buy the cheapest kind of thing. So, but again, that has not actually worked. I mean, even in US it hasn't worked because in India, I don't think I tried to test it out, but the problem is that Indian data, especially, if you need 20 years, 30 years of data to really deeply test, because we have only 4 data points every year kind of thing. So you need enough data points kind of thing. And if you want to test it out, there is no real quality data if you go back 5, 10 years or even above kind of thing. So, but overall, what my thought process is quality as a factor in India is very tough to run because you get all kinds of crappy stocks which are cheap for a reason kind of thing. And if you don't exploit them, I mean, it's like Russia has been always. I mean, if you take the CAPE ratio, CAP, that cyclical adjusted P ratio, Russia has been the cheapest for long. I mean, you can go back 10 years and see that Russia was the cheapest. And Russia has been one of the most, and America has been the most expensive all the time. And America has delivered. I mean, if you were to go buy only the cheapest, you would still underperform the most costliest kind of thing markets in the world. So I think Indian markets, I don't think is suited for quantitative based value. Quality, I think, quality you can do much better kind of thing. I mean, if you look at Saurabh Mukherjee's coffee can model, I'm using a similar thought process kind of thing because the idea is you are looking at companies that have generated decent growth, long-term, sustained earnings growth kind of thing, and saying, can I bet on these companies and the expectation that companies will continue to grow in the way they have grown. And most of them do deliver. I mean, end of the day, not everyone may deliver, but if you have 8 of 10 deliver and 2 even go bankrupt, you will still have a much better return than what you can get by just buying the index, for example.
Got it. So okay, got it. So Prashant, tell me one thing. I mean, is it we often hear this statistic, right, that fund managers, 95% of the fund managers are not able to beat the benchmark index. Okay, it could be S&P in the case of US, it could be Nifty in our case. But first of all, is this a factually correct statement? Do you believe, or maybe just a
no, actually, you look at the data. This guy, SP, this guy comes out with data kind of thing, and a lot of funds don't actually beat the benchmark kind of thing. But again, is the benchmark the correct way to look at it? I don't know, yeah. I mean, active investing, I still think, active investing is tough. Active investing beating the benchmark is tough because there are limitations. There are, in terms of risk. For example, let's assume you're at some point of time recently, BSE Sensex had Reliance, which also having a weight greater than 10% for Reliance. I think 12% or something. But your mutual funds can't go about 10%. So when that happens, you instantly start having a, underperformance just because of the fact that you are not allowed to do. I mean, you are not allowed to buy more Reliance kind of thing. But it's tough. I mean, look, I mean, if you, I mean, you go by the Pareto principle kind of thing, 80% of money is made by 20% kind of thing. I think it applies everywhere, individual, market funds, regardless of what you see. I mean, you can see, I mean, even well-known fund managers have been underperformed kind of thing quite a length of time. So it's possible, I mean, because I mean, the beating, it's very tough. I mean, to beat a index, not because index is great, just because index doesn't really, I mean, it's again, the only way to beat is to be different. And if you are too different, you'll get fired. If you are not too different, again, you become a closet index manager kind of thing. It's tough. I mean, when you're dealing with clients, it's very tough because you are having to explain each and every action. I mean, for example, if you go back to this guy, Charlie Mungers, when he was doing the partnerships, he had 2 years consecutive minus 30% drawdowns. When the Nifty, I mean, S&P was not that much down. I mean, but that's a risk one has to take if one has to be different kind of thing. But that's not something that is easily able to sell kind of thing. We don't have a ability. I mean, there's no. I mean, the only reason Warren Buffett has survived so long is because he has permanent capital, not because his strategy has. I mean, strategy is delivered, but without the permanent capital, it would be very tough because it's people's money. I mean, when we are dealing with people money, it becomes tougher. You have to keep explaining. So, but I mean. The data is there. Data is there. It says that a majority of funds don't actually perform the indices kind of thing.
So I was reading some tweet the other day. Actually, not other day, just yesterday. Actually, so where someone was saying that despite of brutal fall that we had yesterday, his clients, whoever that person was, his clients were actually inquiring whether we hello. Prashant,
Viraj,
can you hear me?
it's Viraj Mehta. Viraj Mehta tweeted. Ravi Dharmshi tweeted same thing. I think Anand Mohan also tweeted. Balaji tweeted kind of thing. So I mean, all of these guys actually have what do you say? I mean, managing 1,000 crore plus. I think the markets. I mean, that's what I was in the conversation myself. I feel. I mean, people have matured. People have matured to accept volatility as a part of. I mean, but I don't know whether that has maturity has come because of the recency bias, because everyone saw how fast market has recovered from the crashes, and you keep seeing that. I mean, it doesn't matter what has happened, you will always recover kind of thing. You'll always make money. All you have to do is just be invested in kind of thing, and that has helped too, because finally economy is growing, and as the economy grows, your prices, I mean, stock market at some point of time will actually start going back kind of thing, regardless of. I mean, we haven't seen a 1929. I mean, as I said, even we haven't seen a 2000 .com bust kind of scenario where we had market was more or less bearish for 2.5 years kind of thing. We haven't seen that for now 50 years. So when you have very long periods of bullishness, it's very. I mean, maybe. I mean, I don't know whether this time is different kind of thing, but maybe people have got accepted the fact that as long as you keep investing, you don't have to worry, because in the long term markets will only go up.
Yeah. And are you by any chance sort of questioning that fundamental belief that, or you think India is that probably holds true for India? Is that what you think by any chance?
No, I mean, look, there's no. I mean, India is no different from rest of the world kind of thing. Again, I mean, Indian. If you go back to 2007, 8, for example, I mean, yeah, valuations were expensive. I mean, no queries on that. But Indian companies were actually growing very strongly. I mean, you look at the growth of the last few years kind of thing in 2007, 8 kind of thing, very spectacular growth. But the whole reason market came down was not because something happened in India, something happened in US, and we are literally every part of the world came down kind of thing. So I mean, there's no this decoupling theory. I don't think holds. The question is how long. I mean, no one knows. I don't think anyone knows how long. I mean, right now, for example, when 2008 happened and Fed came in with a large, I mean, opening up its balance sheet kind of thing. There were calls that, I mean, this will spike up inflation, we'll go back to hyperinflation period, and market will crash kind of thing. That never happened. 10 years, I mean, market has been one of the best 10 years ever kind of thing. Now, again, they will use the same playbook kind of thing in a more aggressive manner with COVID. Yeah, inflation is a bit high, but not really out of their control, at least at that current juncture kind of thing. So I don't think, I mean, yeah, in theory, we can all talk about whether this is the way kind of thing. But if you try to implement it, then you will end up underperforming even the worst of the benchmarks kind of thing, because you will always feel that maybe I mean, markets are expensive. I mean, even if you look at the Cape, Indian markets are as expensive as the US markets kind of thing. It's not cheap. But there has to be some amount of self-belief saying that, boss, okay, overall, we will actually make money kind of thing. And I mean, as the Chuck Prince said, keep dancing till the party ends kind of.
Yeah, 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 yeah. Hmm. Hmm. So maybe we'll soon go to the audience round, but maybe couple of more questions, Prashant. So this current situation with Ukraine and the fall that we had, uh, my question is more fundamental. While this thing maybe one of the factors, but overall, what's your sort of reading of the markets, as in and again, nobody can predict, this is more just an academic question. What's your overall sense that you're getting? Are we sort of is this just a temporary phase of some downturn, or do you think we are probably going to be consolidating like this for for a longer period? Or what's your overall sense of the market, in the context of the Fed rate hikes now, in the context of Ukraine, in the context of everything? I mean, generally.
I mean, look, we have had a wonderful 1.5 years kind of thing. If you look at last 1.5 years, was the most wonderful ever. I mean, 18 months, you couldn't have seen such a rise ever. I mean, I don't think we have seen that kind of strong rise a very long time. So some amount of consolidation was bound to happen. Now the consolidation has come in at a much faster pace than what I did not expect. I mean, personally, I did not expect Ukraine of all the issues to crop up like this and drag down the markets. But I don't think Ukraine will actually impact in a larger time frame kind of thing, because Ukraine finally, look, America or Europe is not going to. I mean, there's no interest in either America or Europe to go out in the all-out war with Russia kind of thing. They are not even going for effective sanctions kind of thing, saying that we will sanction out taking them out of the SWIFT, for example, would be huge. But I don't think they are doing that either. No one wants that. Basically, no one wants to up the game kind of thing. Ukraine will be left. I mean, Crimea. If you go back to Russian, history kind of thing, they did this first with Georgia, then did with Ukraine in Crimea, and now Ukraine actual kind of thing. I don't think. I mean, there's no stomach for taking on Russia at the current juncture. I don't think markets freaked out because the expectation was, what if Russia tomorrow cuts out the gas for your Europe, and 35% of energy requirements for Europe, especially Germany, comes from Russia. So if that happens, then it's a huge drag kind of thing. Your energy prices will shoot up anything, big time kind of thing. But I don't think, markets are now getting the expectation that nothing of that sort will happen. We are all is well kind of thing. It's just a matter of 2 days. I mean, your crude oil is now dropping. Basically, I think it is below 90 as well. So, I mean, that just shows the indication that the market believes that that was still past kind of thing. And I myself, my own thought process is we may be more of a range bound for quite some time, because a lot of stocks have been, we have in terms of valuation, a lot of stocks are actually expensive. Though now actually suddenly become cheap. But unless some aggressive buying comes in, which won't come in, that expense itself. I mean, the aggressive buying doesn't happen right away kind of thing. So I think some amount of cooling off will happen, but I don't perceive a deep crash from here on.
Got it. So the last question that I'd like to ask you, Prashant, before we go on to the audience round, is having been in the markets now for almost 25 years, almost. If you could maybe want to share with us, what are some of the mistakes that you did in your your trading or investing, your overall journey as a market participant, and what is it that you would like others to learn from those mistakes and sort of not repeat them? Any advice that you would like to give to us?
I'm too small a guy to give advice, but my opinion is simple. Nowadays, everyone who says that is interested in market, I say, boss, go do an MBA kind of thing. You want a foundation here. I mean, one of the things I now realized was that a lack of foundation. I mean, that took a year. You can still run in the markets. I was lucky that I got that dot-com bubble kind of thing. Well, and I made money that gave me some amount of confidence and timing kind of thing. But overall, if not for that, I mean, it's tough to survive. I mean, as I said, Bangalore Stock Exchange had around 300 stockbrokers in around 98, 1999, 2000 kind of thing. Today, less than 50 are there. And the guys who are left are all left not because, I mean, brokerage rates have fallen, but we are all one-man shows. It's not like we were having a large, company and so we couldn't service, work it out kind of thing. But basically, it's most of us came out without foundations, and when the market went down, we were in a sticky situation kind of thing. It's, your bad luck happens only when during those times you take a lot of chances. It doesn't fail. I mean, it doesn't work out kind of thing. My own grief is more of getting. I started off in an investor, as I said, but then I slided into becoming a trader. Just because of the fact that I felt that, I mean, being a broker, you are sitting all the time in front of the screen kind of thing, and there's always this itch that maybe you can make easier money. I mean, why do you want to wait for a year to make 18% or 12% when you can make it maybe in a month or less kind of thing if you are right by taking some number of leverage. But trading, I mean, Zero Kamat has commented, I myself have seen in the last 20 years, I haven't seen a single guy make big money in the market trading, purely trading kind of thing. Yeah, Twitter, there are plenty of guys who are seemingly making tons of money, but even those tons of money are being made up by someone else. I mean, basically, someone else is losing those tons of money. This guy is actually accumulating. So the odds of, I mean, for me, one of my, regrets would be, again, lack of formal education, because that would have given me a really heads up kind of thing when what to expect and how do you go through. But I think, again, phase of life kind of thing, somehow I've luckily survived. That's my biggest, I mean, without actually, I've been bankrupt once because of my, let's say, some amount of bad luck and some amount of understanding of the risk I was taking kind of thing. And despite all that, very fact that I've survived, because I see people who are more experienced, more knowledgeable than me, and they have just quit the market kind of thing. I've seen a lot of people, I know a lot of people who have just quit the market. I mean, when you are a broker, you can actually, and especially when we were brokers in the, no, I did not come in outright system, but even after, the stockbroking was not as non-relationship as today, when you are just opening account without actually even bothering with you kind of thing. Every account meant that you have to add 30 signatures. We used to travel to the broker's, client place, get his signature. And it was personal touch, personal. I still have friends that I know from say around 96, 97 who are still around there in the business kind of thing. So it was very personal kind of thing, and you could see, how losses impacted them, impacted their families. Money people, when people lose money, I've seen people lose their assets kind of thing, trying to claw back whatever they've lost. And markets does that. Makes you take very stupid decisions. In hindsight, it looks stupid. At that point of time, it looked the best call that one could have made kind of thing. But to youngsters, my only thought process is, have a professional education, because that will give you a heads up that no matter how much experience you, experience also can give you the same thing, but it will take a toll in terms of the years, and all those years you need to survive as well. Not easy.
Yeah, I get it. Yeah. No, thanks, Prashant, for that. So we'll sort of maybe open it up for the people, for the audience to ask questions. I think we have one CB Chakravarti. CB, why don't you go ahead, ask a question?
Hey, can you hear me?
Yeah.
So, hey, Prashanth, hey, God. So, there's been a lot of scenarios in markets, right? There's low inflation scenario, there's different regimes, basically. So, I wanted to get your take on what would be the best approach for a layman investor to tackle the high inflation regime. So, you don't have cash because inflation is the worst enemy against cash. So what else should he do? Should he invest in gold? But gold is not a productive asset. It doesn't have much utility. But stock markets also, with inflation, they seem to go down when it's peaking. So what would be the best approach for an average investor? That's what I was my question.
I mean, basically the best approach. I mean, I'm biased towards equity. I'm against gold kind of thing. I don't think even gold. I mean, yeah, gold may. I mean, may be a hedge kind of thing for in certain situations, but I'm not in favor of gold or anything else. But the point is that people are not. I mean, inflation. The real hedge is only equity, but equity comes with its own issues in terms of volatility. In terms of, I mean, one day drawdown, and people. I mean, you get a ton of calls. People worried whether, I mean, what if it goes down even further kind of thing? I mean, I have had friends who 20 years experience sold out at the bottom of the, what do you say, corona bubble, worst kind of thing, because they felt that was the whole economy is closed. I mean, at least let me have some amount of cash kind of thing. So, I mean, there's no easy way kind of thing. I mean, inflation, again, your fixed deposits will basically are eating at a slow rate. I mean, it's still decaying, but it's at a slow rate of decay. And if you go by, I mean, have a tax hike on that, it's one faster decay. But I don't think there's any other than real estate. But real estate itself, again, it's not really a hedge. I mean, it's a kind of hedge against inflation, but bigger ticket size and everything. I mean, which is why actually, if you look at people want to invest in a real estate rather than in anything else, because it's in a way indirectly what is. I mean, you are at least your prices go up in the long term by inflation measures, if not anything. And if there's some amount of growth adding to that, that can really give you a bonanza. But I don't know whether, I mean, the right asset classes has to be equity, because that's the only asset class. I mean, companies can actually, what do you say? I mean, your cigarette, I mean, when the government raises tax on cigarette, it gets passed on to the customers. So the customer, I mean, cost increase. The only companies can do that, increase the cost. I mean, when there's a cost inflation, you increase the cost, because that market, regardless of whether it absorbs or not, you have to do that, because else you will not survive. And finally, there is enough demand. There is always demand kind of thing. It's not like tomorrow I will stop eating biscuits or so. I mean, no, stop using soap because inflation is high kind of thing. So that ability to pass the inflation, that I think comes only in equity, nothing else.
Right.
Thanks for your answer, Prashant. I mean, I'm okay to pass on to other people, but if that is fine, I have a second question also.
Yeah,
Sure.
yeah. Go ahead, go ahead.
Okay, so so most investors who have already made it, who are successful, who are running multi-billion-dollar hedge funds, seem to give give credit to concentration, because they are very their bets are very high conviction, and they tend to concentrate, like Warren Buffett or any other successful investors. There, if you look at their portfolio, you can see concentrated investments in in a single digit number of bets, or small double digits. But what all people are aiming to beat, or most of the people are trying to beat, is the index, which itself consists of 50 stocks as a minimum, Nifty 50, and S&P 500 consists of 500 stocks. Right. So when an index, which is basically it's basically a trading system, right? It has a logic. It is using market cap to shuffle around the stocks, but then it is using 500 stocks and able to beat most of the people. So why shouldn't diversification be a good solution, or why aren't there more investors who are successful even though they have diversified bets? I'm not sure if my question was crisp,
No,
but
I mean, there are guys. I mean, you look at Peter Lynch portfolio. He was highly diversified. I mean, you look. I mean, the number of stocks. Or today, you could look at AQR. I mean, you look at their portfolios kind of thing. Even their momentum portfolio, I think, has maybe 600 stocks or something of that sort. So diversification in itself shouldn't really matter. Look, at the end of the day, what you are looking at. I mean, the concentration. The reason concentration people know concentration is. I mean, like. Charlie Munger says, and even Warren Buffett actually said. I mean, I did not realize Warren Buffett had actually spoken about it. So he has said that three stocks are very good kind of thing, and Charlie Munger said all you have to do is pick very good companies, three stocks, and watch them closely. Point is that we are public here. I mean, at least in America, you can change. I mean, a guy with 2% stake can try and change the board composition kind of thing. Here, a guy with 20% stake can't change the board composition. Forget about 2% guys. And we are outsiders. To be honest, we don't. I mean, we can think about ourselves as being the partners with a company. It's all bullshit in my opinion, because finally we just get delivered what the company wants. I mean, promoters want to deliver us kind of thing. So in our scenario, I don't think concentration, yeah, it looks interesting because we look at the survivors and say, was all those have concentrated, but there are a lot of guys who actually were very diversified and still made a lot of money. Point is that diversification again, how I mean, you take the Nifty 50 or Nifty SP 500. Yeah, 500 stock, I mean, your tail is long, but actually concentrate, even there, you are 80% of the weight comes in the top 20% kind of thing. So it's not really a very, I mean, it's not an equal-rated, what do you say? I mean, even equal-rated has beaten for that matter, so it's a different game. But what I'm trying to say is that concentration for most investors won't work because we don't have a clue about a company. I mean, we know only what a company wishes us to know kind of thing. Other than that, we don't know. And we don't really have I mean, unless you are really a guy who is very, very deep domain expertise, who knows how, I mean, for example, I'm in the stockbroking industry. And when Zerodha came in, assume Zerodha had made an IPO at 2010. I wouldn't have subscribed. I'm very purely honest because I thought that this is the shittiest industry. I mean, it's already dying kind of thing. And this guy is coming and saying, I'll make money at 20 by giving orders at only $20 when we were actually charging on a percentage basis. So in hindsight, it all looks crazy that, okay, today, I mean, if only I had also done that kind of thing. But I mean, take even that same business model, Zerodha business model. I know few guys who came after that. No one has actually made money. Zerodha is the only guy who has actually made real money kind of thing. I mean, it's like holding 80% of the profits. I mean, I think if you were to combine all the profits of the stockbrokers, 80% is made by Zerodha and maybe a couple of others kind of thing. Rest of them are the long tails. But concentration, I mean, I believe more in conviction. I mean, basically concentration in terms of allocation itself. For example, my own personal portfolio is 30 stocks, which is a bit more diversified than what everyone says. Everyone talks about 15 stocks, 20 stocks. I mean, even data can show well in 2022 is a good optimal number kind of thing. But I chose 30 because I felt that it will give me more safety, my margin of safety kind of thing. At the same time, my point is I'm concentrated in terms of being more exposed to equity kind of thing. I'm 90% exposed to equity. So for me, even if there's a dilution in returns because of my, what do you say, diversification, overall I'll make, I mean, in terms of absolute, I'll make more money than I could have done because I would actually bet more. Rather than saying bet on 5 stocks, but I'll bet only 20% of my money kind of thing. I mean, I feel this is a better way kind of thing, wherein I can have a better handle on things when the things go bad.
Yeah. So the next question we have is from Presso Button. Go ahead.
Yeah, hello Prashanth. Maybe 3 points for you. I have been following you on Twitter for some time now, and I really enjoyed it. And I hope circumstances are such that you're able to continue doing that. And point number 2 is I keep reading about FIRE, financial independence. What's your opinion on that? Maybe it's not directly related to stocks. That's about it, brother. Thanks.
Thanks for kind words. So financial independence, I think it has taken root only very recently. I mean, again, I think that only matters when you are really working at somewhere where you don't like to work and you want to get out of it kind of thing. There's this NYU professor Scott Galloway. He says that don't chase your passion, make your work your passion, because that's the only way you can actually survive for the long term. And financial independence, we never know, yeah. I mean, today we can say 1 crore is enough. Tomorrow things go, change. And I mean, right now, for example, there are people in the 30s, 40s claiming that I was retired because I made enough money kind of thing. But the question is, what do you do in life? I mean, 60 years, I mean, even today, Charlie Munger at 99 goes to work kind of thing. I believe in independence. I mean, I believe that you need to have enough money. But the concept is becoming more of a fad wherein you are just chasing for the sake of chasing. You are, postponing all your, don't go on holidays because it's expensive. You cut down on your, you cut down everywhere to just save more. And then invest everything, hoping that at some point of time you will be able to have enough money that you can retire. But you never know what is enough. I mean, that's the biggest, if you go into financial planning, the biggest question for most is we never know how much is enough because, I was reading a recently book on financial planning. He said you have to plan for 100 years, living 100 years, because we are already at 75 plus in terms of expectancy. That is for across India kind of. And then you have, we are better exposed to health. We are in metro cities kind of thing. Our healthcare is becoming better, which means that we may be able to survive even longer. When you're looking at 100 plus kind of thing, and who knows, tomorrow, 20 years later, 30 years later, maybe there's a new technology that can extend our life for another 20 years. So, can you really sustain on a capital at, as I said, forget the capital. My point is that what do you do is the key. And if you're not doing anything that is not giving you the enjoyment, then it doesn't matter how much money you really make kind of thing, because our peak period is what? Between 20 to 40, 50. After that, you won't get a job anyway. Once you leave that. So the only thing we can continue doing is what we have done in 20 years kind of thing. So, I'm not exactly a fan of fire kind of thing, though it's very interesting in a way. I don't know whether it answers your question, because I don't think, it's all, in US, there's a social security. In US, there's enough for, if you go back, if you try something and fail, no one will taunt you kind of thing that you failed. Here, you can't even do that. So it's, we are in a very different climate. We are in a different world psychologically. I don't think it makes sense to go for a fire model here, sacrificing at a younger age and then hoping that all will be well in a older age kind of thing.
Yeah. So, POP, did that sort of answer your question?
Yeah. I appreciate what Prashanth added. And again, thanks once again, Prashanth. Hope you are able to keep sharing that good stuff. Yeah.
I'm addicted to Twitter, so don't worry. As long as Twitter is there, I should be there. This is addiction that doesn't go away kind of thing. I've tried to remove myself, but it doesn't work out that way. And I think Twitter is a great way to. I keep reading. A lot of my reads, lot of my the interviews I hear and podcasts I hear are all based because of Twitter itself. So I don't think. It's a great medium to interact and get to know others, get to know their thought process, their strategies. And finally, we are in a market that we need to be exposed to everything that is happening. A guy in the street doesn't have to bother what's happening in Ukraine. We have to bother because, it's a bread and butter in a way kind of thing, even though we may not actually be able to decipher what's really happening. But we at least need to have an understanding what's happening and need to keep following up kind of thing. So I think Twitter is a great medium for that.
Right. Pawan, go ahead, ask a question.
Yeah, hi Gordon. Hi Prashanth. I think I follow both of you guys on Twitter, and thanks for your knowledge sharing. My question is basically on this momentum investing. So even on the portfolio yoga, I think you have these small cases, right, where you take a decision on every week or every month. I think monthly small cases is what you have, right, Prashanth?
Yeah.
So, yeah. So basically, like I have gone through the back tests, and there is a particular drawdown, right, that we come out of when you compare the history. So, I just wanted to know, like, what is the threshold we should keep apart from the drawdown, whatever we observed in the past. So basically, this is a principle of cutting the losers and riding the winners. I think even Gordon does that. He used to share on his Excel also. So I just wanted to know the threshold that we have to keep. Over and above the historical drawdown, whatever we observed from the past data.
So, my point is drawdown, you always need to expect the worst kind of thing. And next, worst is basically index kind of thing. I don't think we'll go to a 80% like that Great Depression drawdown kind of thing. Even a 60% of that happened in 2008. That was a very different scenario. I don't know whether we'll again go through that similar kind of drawdowns. But drawdown, it's always better that prepared for a worst end of, we can always be better than that. But the point is that mentally, if you are not prepared for a drawdown, it becomes very tough when the real drawdown hits, because then you are not really sure what to do kind of thing. To be honest, I had not started advisory portfolio in 2020 when COVID happened. And mine is a monthly rotation. So if you look at the whole COVID crash happened within 20, 23 days kind of thing. 23rd, I think, was the low of the Nifty. And I just, sat through it kind of thing. I got hit, I think 24% or 26% for that month. But the point is that, I was comfortable. If you look at my tweets, even at those times, I was looking at my own historical benchmarking in terms of drawdown and said, boss, this is in line with what I should have expected. It's not out of line. And as long as it's in line, I don't think there's a reason to ditch that system. The whole problem with DIY investing, everyone wants to do DIY investing, but most people are not prepared because that is, DIY is cheap. If you are to say have 1 crore of rupees and invest in say a mutual fund, you will pay around 1 lakh of rupees as fees minimum. And with PMSs, it will be around 2 to 3 lakh kind of thing per year. DIY, you can do it at a fraction of the cost. But the reason you can do it a fraction of the cost is because the whole emotional baggage is being transferred to you as an investor. You are actually supposed to deal with all the drawdowns, deal with all the changes. It's tough, but that takes time. I think the conviction comes from the time itself. You can't, no matter how much I read, how much I hear kind of thing adults, it's all nice to talk about how Amazon has fallen 80% price and still been one of the best stocks that has delivered huge returns kind of thing. But you can't live, living in that and looking, reading over that is way too different. Because right now, take the right now Ukraine crisis kind of thing. Right now, is it a time to buy more or is it a time to hold? No one knows. If you buy and it keeps dropping down, what's the next point? What's the next decision you make kind of thing? So I think, being once you prepare for the worst, I think it becomes much more easier. At least you know, okay, this is not something that I shouldn't have expected. This is something that in line, and let me see how it goes from here kind of thing. Because if you expect something that is not the worst and then you have the worst, you will never, that's where people generally freak out, I believe.
Yeah, absolutely, Prashant. Thank you. I think thanks for the insights. Yeah, it is very emotional, as you said. We get for a fraction of the cost, but it is really tough to travel through the journey, especially during this time.
I can do a 15, 20, or 50-year backtest in what? Fraction of a minute, 2 minutes, 5 minutes kind of thing. Living through 5 days of a drawdown. That's, yesterday for day before, yesterday, day before yesterday, it was, really you are seeing the stocks fall from the morning kind of thing. You are wondering what to do kind of thing. It's very, it's an emotional tough thing to be invested. That's I think what's the reason why most of us actually underperform is because we get too attached, and then losses are real, right? The losses, even though it may be notional at that point of time, it's real loss. You are looking at your portfolio go down by, depending upon the size, a few lakhs kind of thing, and that's real money that's going down the drain kind of thing. So that emotional handling, that emotion, I think is the key.
Yeah.
Thank you.
Thank you. So I'll invite the next question from Sandeep.
Yeah, thank you very much. Actually, I'm following both of you on Twitter, and it gives me real deep insight, especially for the freshers and the newcomers, because I want to know, what is the piece of advice you would like to give to the newcomers? Because since COVID lockdown started happening from 2020, it's a being of market full of participants who are really new to the market. So, what are the golden advice you would like to give to the newcomers while dealing with the market?
I don't think there's any golden advice you can give here. Honestly, I don't know. Again, the question is key survivor kind of thing. I think the question is, what I would suggest is read a lot of history kind of thing. I used to love history even during my school days. So that's something that always fascinated me, because history teaches you a lot about what has happened, and that gives you a kind of a framework of what to expect. Once you know what to expect, then it becomes more easier to handle. And and finally, the question is not about beating the market. At least for first few years, the idea is to just survive the markets kind of thing. If you can survive without actually losing your marbles kind of thing, I think that itself is a great achievement. The longer you go, the fewer actually who actually survive kind of thing. Survive, when I say survive, actually as in being fully active in the markets kind of thing, as in being a full-time investor in that sense, or being even a full-time, having a greater part of our net assets in equities. Most of us will, basically people I know who have survived, but they were actually transferred their net assets to real estate schemes. They are more comfortable and still play with a small amount of equity that may or may not actually change their life in any way, kind of thing. But I don't think there's any golden nuggets or something of that sort. I mean, everyone has to find their own route. Everyone has to find, I mean, some things. I mean, for me, momentum work because I came from a trading background. I came from a trend following background, kind of thing. But for some, I have friends who are came. I mean, who for them who value works because they are more comfortable with understanding balance sheet. They are more comfortable with understanding companies, businesses, kind of thing. So the question is, you need to find what actually is more comforting to you, what actually makes sense to you, kind of thing. Because I mean, we are in one ways. I mean, someone said we are the momentum monkeys, kind of thing, betting on market prices, which is maybe true. I mean, we are maybe monkeys, kind of thing. But point is, it works for me, so it doesn't matter whether I'm called a monkey or a cat, kind of thing, as long as I make money. I mean, I think the Chinese leader said, it doesn't matter if your cat is white or black, as long as it catches mice, kind of thing. Finally, the idea is to make money, kind of.
Yeah, right. Sambaya?
Hi, thanks for your insights. I'm Sambaya. So I started with DIY, and later on I went with Money Life Foundation, not foundation, Money Life Advisory. Again, it takes for me to understand whatever they advise is also not necessarily everything will go up. Or so my idea is start with some amount. If it goes up, increase it. One idea I'm doing it. Sometimes I missed a few of the things their advises, and it went on too much, and then it come down. If I follow some advice, what is your idea? Ideal way of, what is
so? I mean, look, I mean, there are tons of advisors, kind of thing today, kind of thing. My view is that when you are taking advisory, the idea is to, not use just as a platform to, blindly buy, sell, whatever the idea. You do that. Not that I'm not saying you don't do that, but also try to understand. Look, it's a kind of think of it as a filter. So instead of going through all the 1,500 companies, now you have a filter of say 20 companies. Especially on the fundamental side. So okay, what made the guys select this company? It's easier to start digging into company to understand the company, kind of thing. The idea is to look. End of the day, I don't believe. I'm a believer that dependency should not be there, because once you are dependent, and that guy, let's assume you're dependent on one X guy, kind of thing, and that guy decides, boss, I'm done with it, and tomorrow you don't know how do you continue, kind of thing. So I always feel, if you want to survive on the long run, you have to kick out all the dependencies, and the only way is to learn. That was a way is a good way to learn the markets, kind of thing, trying to understand their strategies, asking them, you could ask them questions to see what made them select this versus something else that looks as attractive, kind of thing, so that you understand. Not every stock will be success. 80% of the money will be made in only 20% of stocks. So it's a very small set of stocks that actually make money. But even there, at least you are having a filter, in my opinion, that gives you an understanding. The idea is to learn. Learning becomes easier when you are having a set of stocks and okay, these are good stocks as per someone who is pretty good at markets, kind of thing. So how do I come to select some similar stocks on my own, kind of thing? So I think that's the better way than just, because 1 year one advisor will be good, next year someone will be good, kind of thing. It's like the mutual funds of the industry or even a PMS, kind of thing. So no one will be good all the time. So the only way we can sustain ourselves is only if we also have enough understanding that we don't really are, dependent upon that one person in a way. I don't know whether it answers your question, but I think that's the only way I can look at. If you want to look at, say, survive for, say, 20 years, 30 years, kind of thing, it can't be dependent upon someone else. It has to be your own learning, and the learning comes only, you can start off somewhere. It's better to start off with an advisor, because at least you have a much more smaller set of subsets of stocks that are easy to understand, kind of thing. You can have you have a leg up, kind of thing, rather than starting with, assume I say pharma is good. Pharma has maybe around a couple of 100 companies. You don't know where to start. But if I say in that pharma, this company is great, at least you can start off there, try to read an annual report, try to understand the company. That gives, again, it requires a passion as well. It's not like, you need to have that passion to say, okay, I want to do this. Else, it's better to be in a fund, mutual fund, or maybe even an index fund kind of thing, and leave it at that kind of thing, and just speculate. I mean, invest for the sake of just learning whatever we want to learn, kind of.
Yeah. We'll take the last question, Prashanth, and maybe sign off for the day.
Sure.
Pankaj, go ahead. Ask a question.
Hi, Prashanth.
Hi, Pankaj.
Yeah. So my question is, Prashanth, to you. Like the markets these days have become very, very efficient. So whenever a thing happens, it continues and goes on and on. So same thing happened in March 2020. That market started sliding and it slided for the whole month. So in that case, how do you manage? I mean, you do monthly rebalances. So by the time the month of March would have ended, you would have squared off many of your stocks. So how did you get again into those stocks? Did you get in after April end or during April you started? I mean, what was that? How did you play that COVID March, April months? How did you play those months?
So there's this. Okay, first of all, there's a concept called rebalance luck. I mean, there's a paper on that by Cliff Hofstein, I think. So I think you should just look at it. It's an interesting paper that says that regardless of where you rebalance, there's always a luck factor. I mean, for me, the bad luck was that COVID happened right at the. I mean, at the beginning of the month, it was pretty good. The market was pretty good at the beginning of last day of February, even though it had just dropped below the 200-day EMA. I mean, by the time the month ended, it was, I mean, as you said, I was screwed. I mean, all my happiness had gone off kind of thing, because I think I was down 24 or 26% at that month. And I booked a lot of losses. I mean, basically, I booked out of 50% of my portfolio into cash at the end of March, because there's no stocks to select. I mean, the number of stocks I could select out of my momentum was just 15 stocks. And so I stuck with those 15. And the biggest advantage of studies like momentum, I mean, in March, I was actually long financials and banking stocks majorly. I mean, I got hit. I mean, literally every banking stock got screwed. Screwed my happiness kind of thing. But I mean, I was very long on financials. That was where much of my momentum stocks. Momentum was there before the COVID crash. Post COVID, actually, I mean, my model shifted. I mean, the stocks that started running up were more in pharma, more in specialty chemicals kind of thing. So that changed. But I took more than 8 months kind of thing. I mean, my drawdown actually was started in 2018, not even 20. 20 was one. I mean, it was a bottom kind of thing. But actually, my drawdown started around in January 2018. And then I came back about that, I think, in August or September of 2020. So I think, I mean, again, that's the point I was trying to make, that everything is a cycle. Small cap is a cycle, your momentum is a cycle, everything is a cycle. And you can't, I mean, we can think that we'll get off early kind of thing. I mean, for example, getting off now because the market is fallen, now get off and then get back when the market's again trending up kind of thing. But there's a friction, there's a cost, everything adds up kind of thing. I'm more of a believer that give the market some amount of time and space. And yeah, I mean, as long as I'm prepared for the drawdowns, I suffered a pure heavy drawdown in March, but I haven't changed my system much from then kind of thing, because I still feel that what I did at that point of time was the right decision kind of thing. Maybe I could have taken one mid-month call, but other than that, I think it was right at that point of juncture, because historically, if you go back, there are only very few instances that market cracked like that. I mean, the last time market cracked so big in a single month was in October 2008. So this was, I mean, you can't, I mean, you should try to target that loss 1% kind of thing, that, the fat tails kind of thing. Yeah, you'll actually have to miss out on a lot of other chilies kind of thing. So my point is that, okay, as long as I don't, I mean, my thought process is that all these huge drawdowns don't happen every other day. I mean, we don't, I wrote actually saying that we won't get struck by lightning at the same point twice kind of thing. So my assumption even now is that we will not get hit very badly, at least in a short-term juncture. Even if you go back historically kind of thing, markets have had strong, deep falls once in, say, 6 years, 8 years kind of thing. So that, I think, I mean, as long as I'm prepared for that, I think that's the way, because else it's very tough here. I mean, else you will keep getting out into cash, again, getting back into stocks. I mean, that takes a psychological toll more than, I mean, there's a friction, everything, but the psychological toll is much more harder and not easy to digest kind of thing. I mean, the other day I was listening to a podcast of a fairly large PMS fund manager who said he has not changed his portfolio since, he's a mid and small cap. And he said he has not changed his portfolio since January 2018. He was down, I believe, around 40% in when I last checked. I think SEBI then started not giving the monthly returns in October 20 or something. Sorry, October 19 or October 20, I don't remember. But he was down. He was down aggressively. Now he's back up. He's back onto a high kind of thing. So, idea is you have to stick to the. If you believe in the stop losses, if you believe in the strategy, and you believe that the markets are not going to go down to hell, because if that happens, there are a lot of other issues that India will face. So, the thought process is be optimistic on India and then bet on India by whatever way you want to bet.
Okay, right. Thank you, Prashanth, for your answer.
Oh, sure. Thanks for asking.
Great. So Prashanth, I think we have reached the end of our space. I really would like to thank you for being so candid and honest with your questions and sharing whatever you thought was the response. So first of all, thank you, Prashanth. Thank you a lot, and thanks for spending the Friday evening with us and making this event such a grand success. So I'll as always, I'll keep pestering you with my questions, and you have been kind enough to sort of always help me, and being very approachable. So thanks again for that, and thanks again for joining this event, Prashanth, and wish you a very great weekend ahead.
Thanks, Gordon. Thanks very much.
Thank you, everyone, and have a great weekend, all of you. Bye.